When you sell a covered call, you have some decisions to make. Which one of your stocks do you want to use for the covered call? What strike price do you want to pick? And what's the best expiration to choose? Your choices will largely depend on your preferences and circumstances and your risk tolerance. Making those three decisions have consequences. Some of these consequences take some effort to understand and compute. For example, what's the premium or income, if you prefer, that you'll receive immediately? What's the annualized yield on this income? What's the relative volatility to other options in the chain, which affects its pricing? When's the next earnings date? What's the liquidity? How easy or difficult will it be to sell a specific covered call contract in the market? And how likely is it that your shares will be called away? That's where a tool can really help you see and understand these consequences. Meet the Stockpile Options Scanner. It's free and open source and available on GitHub, linked in the description. It was mostly made by Claude and me, and a couple of community members extended it with other features. Its only job and purpose in the context of this episode is to help you select a covered call to sell. It can do many other things, but we'll stay focused on covered calls in this episode. So let's scan for some good-looking covered calls. I'll use Adobe in this example. And sell and calls are already selected here by default. A typical and reasonable way that many sell covered calls is at a delta of around 30. That means there's about a 30% chance your shares will get called away at expiration. And here's our delta control, so let's narrow the range down to, say, 20 to 40. A common days to expiration, or DTE, is between 1 and 2 months, or around 45 days. So let's set the lower bound to 30 and change the upper bound to 60. Let's also make sure some trades have happened today, so the market has done some price discovery for us. So we'll set the min open interest to 25 and the minimum volume to 10. So in our made-up scenario, we own 100 shares of Adobe. We want to find some candidates for covered calls to sell and choose one. We're going to scan for the most interesting strikes and expirations that meet our filters that we just set. And by the way, this works better if we scan during market hours while stocks and options are trading. The data for these scans come from option chains on Yahoo Finance by default, or Schwab if you configure it. And these sources are both more accurate during market hours. Let's do the scan and see the results. We can also run the scan from the command line and receive the results in text or JSON, but I'll cover that in another episode. The first section of the scan results are these info cards and this chart. This big dot labeled with a 1 is the scanner's most interesting candidate. Before discussing these dots and this chart more, I want to jump down to the top candidates table, which shows where these numbered dots come from. Here's the details of the dot we just noted, this first row. You also saw most of this info in the dots tooltip on the chart. See the expiration column? The chart was just showing one of these expirations. There's a drop down right above the chart that lets you select the other expirations. What's showing up in the top candidate table is affected by the filters we set before the scan. Nothing gets into this table without it passing your filters. We can't say that about the chart. It will show all the strikes of an expiration, but the ones that don't meet the criteria and are not in the top 10 will be small dots compared to the ones that do, like this. This poor little guy's volume didn't meet the min volume filter. The expiration table, just above the top candidates table, will match up with what we're seeing on the chart. It shows all the strikes of an expiration, even if some didn't meet our filter criteria. Here's our sad little dot without a rank. The yellow shaded cells are indicators that an option contract at this strike and expiration may have liquidity issues. Either there's a wider than normal spread between the ask and bid, or there's not much open interest or volume. And back to the chart for a few more callouts. This chart is plotting option contracts for the given expiration. Implied volatility is the y-axis, and strike is the x-axis. It draws a volatility surface line, usually in the shape of a smile, but this one's flatter than normal. The line is computed from all expirations in our DTE filter. More on this in a second. Over here, the vertical line is the spot, the current price of the stock. You can see it's right here between these two strikes, 242 and 246. For a covered call, strikes to the left are in the money and strikes to the right are out of the money. Up here is the next earnings date, June 11th. Volatility is higher for expirations just after earnings. Again, here's the expiration drop down. There's 3 expirations in our filter, and selecting one updates the chart with data from that expiration. Note the one marked with a star is the one that contains the number 1 pick. The chart and the tables are stamped with a date and time here, and which data source was used, Schwab in this case. You can also tell the data source by the color of the dashed line, blue for Schwab and green for Yahoo Finance. This rainbow bar shows the coloring of the dots. Since we're selling a covered call, we like options with higher than expected volatility, the ones above the dashed line, which means better than expected premium. So we like green dots, or at least dots closer to green. Be careful with this though. There could be a very good reason the volatility is higher for a dot, an option contract. So it doesn't necessarily mean it's mispriced. It could be stale data in the chain, which is more likely with Yahoo Finance. You'll want to always confirm the details on your broker before selling the call. A little more about this volatility surface line. Rather than get too wonky here, let's take a brief look at this slide and explain a little more about how this line gets fit. The dashed line is the volatility surface line. This line is computed from all expirations that meet the DTE filters we set. So multiple expirations are pooled together to make this line, not just one. And garbage data is thrown out. Options that have extreme delta and would distort the line are discarded. We're working on a feature that'll let you choose from a few different ways to filter and fit this line, coming soon. Currently, it throws out any option with delta less than 0.05 and greater than 0.95 by default, but that's configurable above. So now we've seen what the scanner surface is, let's make our pick. Here's the top candidates, 1 and 2. The scanner ranked them by IV plus PP, how far above the volatility surface each option is sitting. The higher up, the richer the premium relative to what you'd expect. So let's check a few things before picking. The earnings date is June 11th, and all the expirations are after June 11th. So it looks like we can pick from the top 2 candidates. They're both in the same expiration, July 17th. The number 1 choice gives us more immediate income, over $1,000, but we could miss out on a lot of stock price appreciation all the way from here to here if Adobe makes a move up. I'd probably lean toward number 2, even though its IV plus PP is slightly less than number 1. I prefer to capture more stock upside and be in a better position to roll up and out if needed, but that's just my opinion. I have no data to confirm that's the best choice. Once you've made your pick, take the strike and expiration to your broker and confirm before placing the trade. 2 things to check. Check the scanner's midpoint price in the top candidates table. When you go to sell, you'll probably set your limit price somewhere close to that, maybe just below it. Make sure that limit price still makes sense in the current market. And verify the delta one more time. Markets move. The delta you saw during the scan may have shifted by the time you're ready to trade. The scanner's job is to narrow the field. You make the final call and confirm the details at your broker. I'd like to thank everyone who has watched, liked, subscribed, and commented on the first couple of scanner episodes linked in the description. Here's a small sample of those comments, and they've helped make the scanner a much better tool. And of course, thank you to Claude for being a genius-level coding assistant. There's no chance this exists without Claude. And a special thanks to 2 developers that have contributed their time and effort to improve the scanner, LG Bings and Be Lazy. Here's their pull requests on GitHub that have been merged into the tool. There's a new Discord community linked in the description containing a few channels for discussing the scanner and other topics from my YouTube channel. Next up may be a brief episode focused on rolling one of your existing positions. And again, the scanner is free and open source and available on GitHub. Please consider liking and subscribing if you enjoyed this content. And also, please pause and read this disclaimer. This is not financial advice, and always verify what the scanner is finding before acting. This episode is just scratching the surface, tip of the iceberg of what this scanner can do. We took a curated path finding covered calls for a single ticker, but it can do so much more, and expect future episodes on that content. Also expect improvements and new features, some listed in the Scanner README's roadmap. The previous 2 scanner episodes should have just popped up. One gives an overview and installation details, and the second one's about configuring the Schwab data source. Hope you enjoyed this episode. See you next time, and have a profitable day.